These are some of my favorite little gizmos. In fact, I love most of everything of what I do in this Note Queen job, so that's a good thing. But for tonight, the thing that I'm just going to go over a note deal. A lot of times I notice that I tend to use a some of my consulting clients where we're helping the deal come together. In this case, this is just a note opportunity that was brought to me by a guy who just brokers notes, and he's very, very good. A lot of times, when you're getting new to the note business, you will realize that a lot of brokers are more time wasters than anything else, and so there's very few brokers or note finders, as they sometimes call themselves, that I will actually work with. My present company accepted, of course. I mean, people that are part of my community, I'm much more open to working with, and it's fun. But in terms of people that just source deals, and he's very good. He was a mortgage loan officer before, and so he knows how to put a file together. He's a very good salesperson, and he tees up these investments that he brings to me. I'd say he brings me two or three a month, and maybe we close on one a month, something like that. And so that he's a very good source of deals for me at times, and he makes my life easy. He's practically like a transaction coordinator or assistant, because he just does so much of the details himself on his side, and he'll follow up, and it's really quite nice, and we have a good relationship. But anyhow, just making comments on that in particular. I don't know if any of you have experience that you want to share in terms of trying to broker deals to other people, or people are trying to broker notes to you. But sometimes I get them directly, but like I said, this is one guy that consistently brings me opportunities, and we really enjoy working together. So I just thought I would take this deal that I bid on, I think 2 days ago, that he brought me. He says it's a small California deal, and I actually don't know exactly where. It's got to be in a sort of rural part of California. The security for the note is a 2 bedroom, 1 bath, single family residence. The sales price was 52.5. I'm going to clear my calculator right here. So for you that are just new, I know Patricia, you asked me for the app earlier today so that you could purchase it and follow along, I think. So anyway, just going to go through over some basics as we're figuring this deal out and various ways to play it. So, sales price 52.50. He's saying, but the value is 60,000, and the sales date was in June of this year. So if it's less than a year, I don't go on whatever they say the value is. I'm going to go on what the sales price was, because if it was worth 60, then it should have been sold for 60, especially with owner carry terms, right? Probably cash, this would have sold for 40 or 45. So it's only worth 52.5, probably because of the terms. I'm not sure. But anyway, so I'm going off a value of 52.5. That was just in June, which is only 3, 6, 7, 8, 9, 10, 11, 5 months ago, right? Okay, down payment was good, 22,500, which was a 43% down payment. Just to go over things, not leave anyone behind. So I'm taking the down payment divided by the sales price, 52500, and I get 0.43. And you guys know that you move the decimal place to the right 2 times, put the percent there, and that's the percentage of down payment. This is very good. The credit score, the guy has a 700 plus credit score, so that's very good. Like ding, 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 that's good. Ding, 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 that's good. So the first note in deed of trust is 30, right? 22.5 less the down payment leaves what was left as the note. So I'm going to clear all there and put 30,000 as the loan amount or present value. So that goes here in PV. The interest rate is low, 4%, right? That's low. That's going to put downward pressure on the price of the note. And it's interest only, meaning no principal. So I know that this there's going to be a balloon in 5 years. So I'm going to put 60 in here, because 60 times 12, 5 times 12 is 60, right? 60 months. 5 years times 12 months each. I know that the balloon, I should have done this at the same time. Make it a negative number that goes over here into future value. And let's see. Oops. 30 there. Solve for payment. So his payment's only $100 a month. Okay, so really, really low. What he's trying to do, this is a rental. Okay, he's holding it for rental income. He couldn't get a regular loan because he has lots of properties. I think you can only have 10 investor loans with FHA. The good thing about it being an investor loan is I don't have to worry about, say, the Dodd-Frank stuff that's come up about consumer type loans. Let me look at what Ken just said. So I apologize for the people who see it afterward. They're going to be good. So sales price is $52,500. The down payment, remember we got to the percentage by 22.5 divided by 52.5. Okay, 43% down payment, so that's really good. Credit score is good. The note is 30,000. So to clear all, I hit the shift button and the clear all right below it. I'm going to put 30,000 into PV, present value. Wow. Thanks a lot, Ken. And I'm sorry, all of you. I'm really sorry. Okay. And because it's an interest only, I know that the balloon's going to be exactly that amount, so I'm going to put that into future value over here. I always put these two numbers in as negative, and I always put these numbers as positive, even though there's different ways you can do it, but that's just how I keep things straight in my head. It's 4%, and it's for 60 months. Okay, so that's how we solve for payment. We know 100. The other easy way to do it, you guys know, if it's interest only, 30,000 times 4%, move the decimal place to the left, so 0.04, so that's 4%. That's the interest per year. Then I have to divide by 12 to get the interest per month, and there I have 100. So you can see that you can get this either way. Okay. He's been paying on time by direct deposit for 5 months, so he's current. So that's very positive. I would say with this down payment and this credit, 5 months is great seasoning. The only thing that's going to hurt the value of this, and the fact that there's a balloon is good for present value. And I'm assuming someone who, has other assets is going to be able to pay off the balloon or refinance at least on some level. And there's no Dodd-Frank issues, worrying about putting in a balloon or anything like that. So that makes that kind of simple. So anyway, so there's the deal as it was brought to me. So and if you guys want to make any comments, I will try to keep my eye out. So the next slide. Get this back again. Okay, the next slide. Is me figuring out what I want to pay for it. Okay, and here's so I've got the monthly payment. When I'm figuring it out, we've got the 100 that's already in here because I already recreated the note. There's a balloon. If I buy this note, I'm going to get 100 payments and then a $30,000 balloon in 55 payments, right? The 60. Oops, 60 minus the 5 payments he's made leaves 55 payments left. So that's what I want in N, which is my term. So I'm going to get 55 of these here, and I'm going to get one of these at the end of 55 months. And the only thing I got to figure out is that I don't like this 4% here. For me, I like to always try to get 14%. I can't always. Like I get a super safe note with a lot of, even juicier than this, I'll probably have to go down to 12 or 13 to be competitive. It just depends. So now I've got everything. So I want to solve for present value, which is what I will pay now for the right to receive the rest of the note. So that turns out to be $19,871. And since that's a weird number, I'll just say, I'll just quote him $20,000 Now I'll solve for yield. It's going to drop my yield a little bit, right? Because I'm paying a little bit more, 13.87. So I'll say, look, I'll pay 20,000 for this note. I'll say I'm going to pay for the BPO, the broker's price opinion. It's like $100 way to get an appraisal on a property. So I will pay for that out of my side. And almost always, I make the seller pay for all the closing costs, including the lender's title policy. Sometimes they don't get it like they're supposed to at closing. So if they don't, they've got to buy this. And the reason I make seller pay for all closing costs, because a lot of times they're the ones that want to control where the closing is done. Not always, but so I want them to have to pay all the costs, and I'm just working my yield backwards from the one price that I quote. And I'm always thinking here, look, 20,000, let's figure out, I didn't write it down in here, but 20,000, I'm figuring out my investment to value. So 20,000 divided by the value of the property, 52.5. So basically I would be at 30% investment to value. And remember, there again, the 52.5 is based upon an owner finance deal. If it was a cash sale, a quick cash sale, it'd probably fetch, like I said, in the $40,000 to $45,000 range. Just guessing, could be wrong on that. You never know why the person carried paper. But anyway, I would be happy to own a little rental income. I think property and paper makes sense. I have much more paper in my portfolio than property because I don't like rentals. But what I would do is if I wouldn't mind owning a little rental. It rents for $750. So if I end up owning this, I'm going to be happy because here's what I'm going to do is, I'm in it for 20 foreclosure costs. So, so let's see what I'm in it. If I end up owning this property, then let's say I'll get 750, which is the gross rents times 12, and I'm not counting like 5 or 10% vacancy like I probably should, right? So that's how much money I would get per month, but we know that 40%, it's a safe number to put for expenses, taxes, insurance, and repairs. So basically, I'm going to only take 60% of this because the other 40% I put aside for the other expenses. So I would get $5,400 a month or a year from this property as a rental or thereabouts, divided what I have into it, which is let's divide by, it's not really 20,000. Let's say it costs me 25,000. Let's say I have 5,000 in closing costs and fix it up a little bit or something. So I'll have like a 22% cash on cash return if I end up owning it. And probably what I would do is bring in a joint venture partner in this area so that I have someone who's really as interested in me and making sure the property is managed well. Okay. If seller does not pay all costs, it will cost you about 1%. Okay, you're talking about closing costs, right? If you pay $500 in closing, so a good idea to have them pay. Yes, exactly. And I've had closing costs be as little as, let's say, $250 all in, even less sometimes. And other times, like in Texas, this one deal cost me $1,800. I mean, because the attorneys and how their things work, it was much more expensive. So I let people who sell real estate, they get that there's closing costs and Ken's also saying this is great for IRA money because it is small and you can have someone else go in with you if you don't have the money. Yeah, excellent. This is a great little deal. In fact, I just set myself up with a Roth, self-directed Roth IRA, and I wouldn't have 20,000 into it, but right, I could go in with somebody else's IRA, or there's all sorts of things you have to be careful of prohibitive transactions and things like that. But yeah, this is a good little deal, really safe. Okay, and also if I ended up this with as a rental, yeah, maybe I have a little more exposure owning a property, but then I get to take depreciation unless it's in a qualified account, and I have appreciation, and it's not, I'll have this forever, right? I'll have this asset forever. So anyway, these days I'm thinking of how do I make owning property just as passive and easy for me as owning a note. And so what I'm turned on to is the JV arrangement, the joint venture arrangements, where you get a manager who's competent, who you like, know, and trust, and you give them a piece of it so that it hits their own bottom line by how the property is managed. And so those are the kinds of things that now, based on that kind of a model, I'm willing to look at adding some properties into my portfolio instead of only paper. Okay, so next slide. Okay, so I can borrow money to buy a note. Just like if I was buying a property, I could borrow money to buy a property. I can borrow money to buy a note. I do this quite frequently, and you can do it too. Okay, so if I borrow 20,000, let's say my offer of 20,000 I'm buying at a 13.87% yield. If they accept that, then what if I bring in $20,000, have an investor loan me $20,000? If they are happy with an 8% return, which is a totally fair return for a small amount of money, a lot of safety, and a lot of preservation of capital, and it's totally passive, nothing you got to do about it. If I owed them that, and then the 20,000, it would be a balloon at the end. I wonder how much of a monthly payment they would need. If they brought me 20,000 at 8% for 55 months with a balloon, then how much would they need? Oh, they would need actually more than the guy pays each month. They would need 133.33. And I could do that. I would just, I would be coming out of pocket $33.33 each month. But what would I have at the end of the term? In 55 months, I'd get paid 30,000 and pay off my investor, and I would have gone negative a little bit every year, but basically I'll get 10,000 at the end, right? For basically not too much effort here, right? So I could say I don't need money now. I'm willing to go negative. I'm building equity, and I could do that. Here's another thing I could do, and it just depends on like where I'm at, what I need, what my investor has. If I'm more concerned about protecting them, or there's so much room, I'm not worried at all. If I think a deal's a little bit like I want to keep the investment to value really, really low, then I will take more of my profit through the deal or at the end rather than off the front. So there's a lot of factors that go into this, but let's say I borrow 21,000 instead. So then I get $1,000, put some groceries on the table, put some gas in the car, and the same 8%, but I'm going to make it a negatively amortizing loan for them. So my investor, basically, they're going to get 25,000 of the note, of that $30,000 note. And now I wonder how much of the payment they'd need each month. Okay, then they could take basically $80 a month. I don't know, somehow I got a different number in there, but basically $80 a month, and they give me 21,000. They get $80 a month, and in 4.5 years they get 25,000. That way, I get 1,000 up front, about $20 a month for 55 months. That's another, let's call it $1,100, $1,200, and I would get 5,000 of the balloon, right? So my total would be 7,200 on this really, really small deal. Okay, that works good, right? My investor's happy. They've got a safe little deal going on, nice 8%. Yeah, 6%. I do have people that are borrowing money from people who want to be completely passive at 6 and 7%. So I should probably be asking for that. I'm not yet, but that is very fair, especially when it's totally passive and so much safety, like in this type of deal. If something goes sideways, I'm going to put in the elbow grease. They won't have to worry about it. But anyhow, but next slide. Why do I keep losing that? Okay. All right. Or what if I borrow more up front? I'm comfortable with the collateral and the investment to value here and the borrower. So let's say I need more money now. Let's say, why don't I borrow 25,000? That means up front I can put $5,000 in my pocket. And remember, you guys can do this too. When you're sourcing the deals and finding other investors that want to go in with you, I'm just kind of showing you the different things that I go through when I'm going, okay, what am I going to pay for this note? And am I going to buy it? Am I going to flip it? Like how, what's on the table? Where am I going to make my profit? Do I need more money now? Am I looking for more passive? Am I looking for something more at the end? I don't need it now. There's all sorts of things. So anyway, what if I borrow 25,000? So I'll put that in PV, or loan amount, present value, loan amount there. That same 8%, the same 55 months. And then I'll give them the whole balloon, 30,000. The whole thing is there. Okay, now let's see how much of the monthly payment they would need. Okay, almost all of it, right? There's $8.89 left over to make it worth my while to put stamps on the payment in, the payment out, and that kind of thing. But I would get $5,000 now, $8 a month for that long, and nothing at the end. So I would get a total of almost $5,500. Okay, it kind of seems less than, but remember, if I get this money now, that's money now. Like time value of money lesson here is, 5,000 now is 5,000 now. This buys today $5,000 worth of stuff. Remember in the other deal where I said I would take 1,000 now, maybe $20 a month, and then 5,000 at the end. But let's see what that $5,000 is really worth 4.5 years from now. So to figure that out, here's what I'm going to do. Here's our 55 months. Okay, so then I'm going to assume a 9% inflation rate of inflation. And I think this might be low because it could, but I think this is accurate for now. I'm going to have 0 payments, right? And at the end, I would get $5,000 future value. Make it a negative number right here. Enter it in future value. Now I wonder what it's worth today. What's present value, assuming a 9% inflation rate? If I get 5,000, 55 months from now, what's it worth in terms of today's dollars? It's only worth, this is only going to buy me $3,300 worth of stuff. It won't buy me $5,000 worth of stuff. Okay, so, and if inflation goes up higher, it's even less, right? So basically, I have to look at this like, okay, so the last example where it looked like I made 7,200, really, if you figure for this, it's about the same as this deal, isn't it? Except for this way, I'm getting my money out now. If one of the kids has a root canal or something like that, and I need money now, I just might want to take this. But I could do it the other way too. I never know. You never know how this could go. So, looking for comments. Any questions on that? This is really important concept to get, the time value of money. The reason you can you can structure partials is because a lot of people don't get this concept, because they think $100,000 now is the same as $100,000 10 years from now, and it's just not true. Let's look at this. 120 months, 10 years. Okay, let's assume 10 years. Let's assume 9% inflation rate, and at the end of that time, you're going to get $100,000. No payments for this whole time, but at the end of 10 years, you're going to get $100,000. Let's see what that's worth in terms of today's dollars. It's only worth less than 50 cents on the dollar, 40 cents on the dollar, right? So you would be better off if you know how to invest your money at better than 9% return. And this is only a guesstimate. Everyone has their own number they would really put in there. Then you'd be better to take $41,000 now than $100,000 10 years from now. Okay, this is a really, really important thing to get. Questions, comments? Do you feel sickened by that $100,000 is only going to buy you $40,000 worth of stuff? Okay, that's why, that's why you got to be making more than 1% on your money, right? Because otherwise it's just evaporating so fast. Okay, next thing I could do, I could just decide to broker the note. That means I'll just flip it to somebody, like a wholesaler, right? I'll just be a wholesaler. So let's recreate the note. They're gonna get the monthly payment. If I sell someone this note, like I just don't want it, and somebody else does, $100 a month. They're gonna get a balloon of 30,000. Put it as a negative number. See, these two are negative numbers. Okay, this is what they're gonna get, and they're gonna get 55 of them. 55 of these, and this at the end of 55 months. Okay, so that's if the investor yield, let's say they want 10%. And since I'm not babysitting the note, and they're going to have the risk and the management and things, not that it can be difficult. They can easily get someone to service the note for 15 or 17 bucks a month, and it can be pretty easy. But if something does go wrong, then they're going to have to deal with it. So let's say they're willing to deal with the problem and they're happy with a nice little 10%. So what would they pay for that note? Well, let me solve for present value. They would pay $23,403. Okay, so then if I have it under contract for 20 and I have someone who will buy it for 23,403, then basically out of the proceeds, I will get $3,400 for flipping this note to somebody. Okay, it's less than what I would, do in our previous scenarios, but it's a quick little thing, and this would be a sweet little deal, like for someone's IRA. Wow, Don, this is amazing stuff. Thanks for sharing. Oh, you're welcome, Veronica. It's really wonderful to have you on here. And okay, so what if this deal was a little higher risk? Let's say it wasn't as sweet, like the down payment wasn't as big, the credit wasn't as good, and what was the other thing I liked about it? Well, it had perfect seasoning. It was a rental that I wouldn't mind owning, that kind of thing. All right, so, but what if the investor yield, like someone says, hey, I'm going to need 12% on this. So most investors are looking for somewhere between 9 and 14% on their money. And the more you learn to source your own deals, the higher the yields you can get. But if they need 12%, let's see what they would pay now. Present value. Okay, now they're only going to pay $21,570 for the same note. Now I'm only going to make $1,500, but still, that's pretty easy, right? Making $1,500 to flip it over, to somebody else. That's not bad. It's a small deal. That's really fair. In fact, let's look. What's 1,570 divided by the overall sale of the note, which was 20,000. Basically, that's like 8 points, right? That's not bad. That's like double ending a real estate deal. If I say if I take the balance of the note, then that's like 5 points. That's very fair. 5 points on brokering a deal. And my broker that brought it to me, when I say I'll pay $20,000 for this note, he has to take out his fee. So he might quote the guy 19,000 or 19,500 or 19,250. He knows it's a small deal. He doesn't want to kill it, but he'll easily make 500 to 1,000 on this deal, even when it's small. And actually, I've seen him make more. He's a very good negotiator. I would say he's much better than I am. So sometimes he pulls out even $1,500, $1,800 on a small deal like this. So it's on him to work in his own profit without killing the deal. Okay, any questions? Okay, I think we got that. I hope so. Okay, one last slide, and we're right here at the end. Just wanted to show you like one. Oops, not that. Okay, I just wanted to show you one more thing. I could buy it and then sell a partial. I could do this simultaneously, but just think of it as I use my own money to buy the note for $20,000, and then immediately I sell a partial to an investor and I get my $20,000 back. So why, maybe I would want to do that if I don't need any money now. I don't need the cash flow. I'm just building in things for the end. So if I buy the note for 20, I sell a partial for 20,000 instead of borrow the money to buy the note. I could do it this way. So $20,000. I'm back to the 8%. They're going to get all of the monthly payment, okay, and And so I'm wondering if they put in 20, they get all of the monthly payment instead of, remember that first one was they get like 79 or $80 a month out of the payment. I wonder how much of the balloon they're going to need. So then I'll press for future value. Okay, so they're going to need 205. Okay, I get all my money back to go do something else with. I get all my money back. They get a nice 8% return. And at the end, look, I get 0 up front, 0 each month, but I get 77, basically 7,800 when the balloon pays off at the end of the 4.5 years, right? So that could be a good deal. Isn't that a nice little bonus for your IRA or something like that, or for anything? But there again, we've got to put this number in. That's 4.5 years from now. So let's just redo this whole time value of money thing again. The future value, okay, I'm going to put it as a negative number over here, is, so in 55 months, I could get $77.94. In the meantime, I'm getting 0 monthly payments. I'm assuming 9% inflation. So what am I really getting in terms of today's dollars? Bingo. Okay, right there. Really, it's worth 5,100, even though it looks like 7,800 here. The thing is, I might be willing to do this. The more I leave myself in the back end, because if I end up owning this property, I can just pay off that other person and say, I'm going to own this property, and I have more plays in it. I would have that anyway, but there's lots of reasons why this would make sense. If inflation turns out to be 12%, let's just play with that number. Now the present value is 45. How about crazy 18% inflation? Heaven forbid. Oh my goodness. See how fast the present value of my money, depending on how inflation goes? Okay, this is the invisible tax that the American people have, is inflation. They don't realize it's just like packages at the market getting smaller and smaller. The package costs the same, but it's smaller, right? It's the same idea. What your money will buy, this is the invisible tax, and what happens when they're printing money and some of these other things. So basically then that's what I got. That's the end for now. Any other final questions, comments? Thank you so much for attending and for your questions and comments. And I always appreciate you guys very much. You guys have a wonderful night. Thanks again for being here, and take care. Bye-bye.